that's not a throwaway line. Anytime I have a chance to spend time with a group of entrepreneurs on small business financial management stuff, I really enjoy it. I look forward to it. I've had a 35-year career in the treasurer's office with Armstrong World Industries. And after I retired, I joined SCORE, and I've been doing SCORE small business counseling, mentoring, and workshops for over 20 years. So I guess that means two things. Number one, I'm old as dirt, and yeah, that's true. But number two, it also means I've been around long enough to learn a few things. In fact, I've learned a few things 10 times over. So if I can share some of them with you to help you better manage your business, that's what it's all about for me. Let me get straight into this subject today, and I want to tell you up front the number one thing that should be a takeaway for you from this webinar, and it's simply this: you cannot answer the question, how much money do I need to finance my business plans over the next 12, 18, or 24 months, without doing pro forma cash flow forecasting? You simply cannot answer that question any other way. Let me put it a different way. I suspect that every one of you in the last 3.5 months at one time or another has said to themselves, am I going to have enough money to survive, the next 6 to 12 months, 18 months, until such time as we have an effective vaccine for COVID-19, and we can emerge out the other side from this economic disaster to whatever the new normal is going to look like. That question has to have crossed your mind at one time or another, certainly should have, and it may be what brought you to today's workshop. There are three possible answers to that question. The first one is guess. I guess maybe I will, or I guess maybe I won't. I've never been a particular fan of guessing as a strategy for successful business management. I think the second possibility is to throw your hands up in the air and say, there's no way anybody can reasonably forecast the future, especially in today's circumstances. So why bother? I'll take it as it comes, and somehow I'll manage my way through the process. Well, once again, I've never been a fan of throwing your hands up in the air and saying I'll take it as it comes. That's not planning. To me, failing to plan is definitely planning to fail. And I'm sure you've heard that adage before, but it's very profound. Failing to plan is planning to fail. So the third answer is the only one that makes sense, which is to do pro forma cash flow forecasting, estimate based on all the knowledge and experience that you've got with your business and your knowledge and experience with your numbers, estimate your expected future cash inflows and your expected future cash outflows. And if the inflows are substantially exceeding the outflows, then you should be in good shape. If not, you've got some issues to deal with and some plans to make. There are a lot of ways to skin the cat in terms of finding funds to finance your business, but if you don't know that you're going to need them well in advance, then you've got a problem. So cash flow planning is what that's all about. Kathy, let's look at the next slide. These are my objectives for today's workshop. First, I want to review some of the basics of financial statements and cash flow. basically to make sure we're all on the same wavelength. You know, you've got to use financial statements for this process, and I want to make sure that we all have a common understanding of what I'm talking about. Then I want to share with you a simple cash flow projections template. This is an Excel spreadsheet template. I have a friend who argues that the Excel spreadsheet is the most powerful business management tool ever invented. You know, I love to have that argument with him because I say that it's the to-do list. But whether it's the to-do list or whether it's the Excel spreadsheet, you know, the spreadsheet certainly is a powerful business management tool. And I've got a cash flow projections template to share with you. And then review some example, a simple example, you know, of using that particular tool, talking about how it's vital for your business management purposes, and especially in today's circumstances, you know, of the human and economic disaster that we're struggling with right now. Next slide, Kathy. Quick overview for this, because I want to get to cash flow sooner rather than later. Obviously, financial statements are recording all the transactions that take place during the course of the business operations over a period of time, whether it's 1 month or 3 months or 12 months or longer than that. And the income statement is recording all the income and expenses that have occurred during that period of time. And the balance sheet is capturing the snapshot of the assets and the liabilities at a given point in time. So to me, it's like a train. You know, the income statement shows whether the train is moving forward or whether it's moving backwards, and it shows the speed of the train and how well it's doing in terms of achieving its destination, moving forward or moving backwards. But the balance sheet captures a snapshot of the train at a given point in time, December 31, 2019. You know, what's the train look like? You know, well, it looks like all the assets of the business and all the liabilities of the business at a given point in time. And the cash flow statement basically shows the cash effects of both the income statement events as well as changes in the balance sheet. And it's different from the income statement. The vast majority of you, should be well familiar with income statements and balance sheets in your business, but I don't know how many of you are totally comfortable with and familiar with sources and uses of funds and cash flow statements and cash flow forecasts, which is the purpose of this workshop. Next, Kathy. So to make sure we're on the same wavelength, you know, let's just look at a simple example of an income statement. You know, obviously the income statement is recording all the revenues of the business for the products and services that you've sold. It's recording the direct cost of producing those products and services, the direct material and direct labor, including the benefits of payroll taxes of producing those products and services, and the gross profit margin, the difference between the two. As the example suggests, expressing those numbers and percentages really helps you to compare line items. So for me, gross profit margin as a percent of sales is one of the most important numbers in the entire P&L, maybe even more important than the bottom line, because if you don't get your gross profit margin right for a given type of business, it's exceedingly difficult to succeed in that business. And then, of course, operating expenses cover all the expenses that are basically fixed or semi-fixed, those that don't vary directly with sales. Cost of goods sold varies directly with sales, but rent, advertising, professional services, marketing and promotion may not vary directly with sales. They're fixed or they're semi-fixed. And then 2/3 of the way down the P&L, you're looking at operations, profits, so-called EBITDA, $6,500, 13% of sales in this particular example. That stands for earnings before interest, taxes, depreciation, and amortization. One of my clients sent me a mug that has a C, EBITDA, earnings before interest, taxes, depreciation, amortization, and coronavirus. A lot of bankers call that number cash flow. Interestingly enough, the profit from operations is cash flow, and so when people use that term, it's a good idea to ask them to define what they're talking about, because cash flow can really mean three different things, as I'm going to show to you. But in this particular case, the use of the word cash flow as operating profits means the cash that the business is producing from its operations, and will that be sufficient to cover both interest expense and principal repayments on debt. If you've got a $6,500 profit and your annual interest expense and principal payments on debt is $5,000, then you've got cash flow sufficient to cover the debt service, and that's obviously of interest to a banker who's lending money to a business. And then, of course, after deducting interest expense and depreciation expense, you're looking at net profit. Standard classic income statement. Next, Kathy. If you're not already looking, at your income statement on a monthly basis in a format like this, I certainly suggest that you should. QuickBooks or any other computerized accounting system will produce income and expense statements, P&L statements. I don't know why they call it P&L. It's either P or L to me. It's either profit or loss, but somebody named it P&L. But looking at them on a monthly basis and a year to date, compared against budget or compared against plan, is a very useful way to begin to make your numbers talk to you and tell you a story about the strengths and weaknesses and opportunities for improvement. And so looking at numbers on a monthly basis like that in your P&L, and maybe putting some percentages in, like gross profit margin percentage and operating expense percentage and net profit percentage, is a very helpful process in terms of business management. Next, Kathy. Simple balance sheet example. To me, assets is everything that the business owns. The business owns the cash. The business owns the accounts receivable due from customers for invoices that have been rendered that has not yet been paid. The business owns the inventory of the business. It owns the fixed assets or the property, plant, and equipment, PP&E. Total assets, $100,000 in this particular example. The liabilities are accounts payable and trade creditors, maybe some accrued payroll expenses, and bank debt, working capital line of credit, term debt, long-term, short-term debt. The total liabilities are, in this particular example, $28,000, and the creditors say, I have a $28,000 claim on the $100,000 of assets. And the owners have a $72,000 claim on the $100,000 of assets, because the owners have their initial investment plus profits earned and retained in the business over time, which is shareholders' equity of $72,000. You can see why it's called a balance sheet. The assets equal liabilities plus stockholders' equity. Or another way to look at it is assets $100,000 minus liabilities of $28,000 equals stockholders' equity. But looking at a balance sheet as assets that the business owns and the liabilities as a creditor's claim on those assets and shareholders' equity as owner's claim on those assets, is a good way to look at the snapshot of the moving train, at a given point in time. The next day, that snapshot view is different. Kathy, next slide. Now, cash flow. This is the historical view of cash flow. It's showing the flows of cash in and out of the business during a given point in time. The historical view of cash flow relates directly back to the income statement and the balance sheet. All of the numbers for cash flow come directly out of the income statement and the balance sheet. And I'm going to show you an example of that in a minute. This is the view of cash flow that's commonly called, quote, sources and uses of funds, unquote. There are different types of cash flows. One is from operations results, while another is from investment activities, investment in new fixed assets, for example. And a third type of cash flow coming from financing activities, borrowing and repaying interest-bearing debt. And the bottom line in the cash flow statement, instead of profit like the P&L, the bottom line is the net change in cash, whether or not the cash went up or whether or not the cash went down, whether the business is generating, or using cash during a particular period of time. And I put the little comment at the bottom that a business certainly can be profitable, but fail to survive because it can run out of cash. Classic example of that. This is an example of me being as old as dirt. A classic example of that is Cape Canaveral down in Florida, which of course is Cape Kennedy. I was down there in February with my wife, and we spent a day at the Cape Kennedy Space Center. Fantastic historical museum of our flights to around the world and to the moon and back, and a fantastic view of what Elon Musk and SpaceX are doing in their public-private partnership with NASA to send the next Americans to the moon. But in that particular case, the contractors that were building that entire complex way back in the 1960s were profitable on paper, but they were dying a slow death because they were running out of cash because the government was taking months and months to pay them. All the change orders that took place and collecting their money, from the federal government, was a huge problem for them in terms of cash flow. Next example, Kathy. Next slide, please. Touch very briefly on this, but it's going to be easier to see in an example. Cash flow from operations does start with the net profit, but adds back depreciation expense because it's a non-cash expense. The cash flow from investment activities has to do with purchase or sometimes sale of property, fixed assets, or maybe investments that come into the business. Cash flow from financing activities obviously is going to involve borrowing or repaying money, but also things like dividend payments or profit distributions to owners out of the business. Next slide, Kathy. Before getting to an example, it's worthwhile taking a couple of minutes to reflect on this slide. And you see the basic question that's posed in this slide, which is what are the transactions that show up in a cash flow statement that don't appear in the P&L report? And I've listed those for you. The repayment of loan principal on interest-bearing debt is not a P&L item. You don't show repayment of principal on debt in the P&L. You show it, interest expense shows up, but not the principal repayment. But it certainly does show up in the cash flow because it's a cash outflow item. So it's a classic example of how something appears in the cash flow statement that does not appear in the P&L statement. Also, as a suggested, profit distributions to owners. Many small businesses, the owner may pay themselves a small salary, W-2 salary compensation, and the rest of the money they might distribute to themselves, out of the business as profit distributions. Well, that doesn't show up in the P&L. It's not like salary compensation. It's just simply it's more like a dividend out of retained earnings. So it's a balance sheet transaction. It's not a P&L transaction. Increases or decreases in accounts receivable and inventory and accounts payable to trade creditors all are cash flow transactions that show up in a cash flow statement, but not in a P&L. Same thing with purchases of new fixed assets, increases or even decreases in long-term debt, and increases and decreases in bank line of credit. So I guess one of the reasons for showing you this is to show you that if you're watching and paying attention to and using your income and statement and your balance sheet for manage your business, but not using cash flow statement for the same purpose, then you've got a two-legged stool instead of a three-legged stool, because cash flow shows you a very different picture, more like a checkbook picture, of the financial results of the business. Next slide, Kathy. Simple example of what I've been talking about. There's the same income statement that I used as an example. On the left-hand side, there's the same balance sheet that I used as an example, but in this case, it's the beginning of the year and the end of the year, and showing the net change, in the assets and the liabilities and the stockholders' equity. And from those two statements, I can derive the cash flow, and that's on the right-hand side. The beginning cash in the bank at the beginning of the year was $18,000. The cash flow from operations is next. That's the net profit of the business, $5,000. And then I'm adding back the depreciation expense, because depreciation is a non-cash expense. If I buy a $10,000 fixed asset, and it has a 10-year estimated useful life, then I'm depreciating that asset or writing it off $1,000 a year. That's depreciation expense. But the cash event occurred, when I bought the asset. So depreciation is a non-cash expense. I add it back. Accounts receivable going up from 18,000 to 20,000 means that was a use of funds, so the change in accounts receivable is a negative cash flow event of 2,000. Same thing with the change in inventory going up from 29,000 to 30,000. But increases in accounts payable to trade creditors of $2,000, dropping down to the liability side of the balance sheet. Thanks, Kathy. And the increase in accrued payroll of $1,000, all together shows a total of $6,000 of cash inflow from operations. Profit plus depreciation, minus the increase in receivables and inventory, plus the increases in payables and accrued payroll, total $6,000 of cash flow from operations. And then from investment activities, we had a $3,000 purchase of equipment, so that's a negative cash flow item. And finally, we had a decrease in loan payable, paid off $1,000 of debt. So the net cash flow in the business is $6,000 in, minus $3,000, minus $1,000 out, and that's a positive cash flow result of $2,000. Cash went up from 18,000 at the beginning of the year to 20,000 at the end of the year. Classic example of sources and uses of funds or cash flow increases and decreases resulting in the change in cash in the bank account between the beginning of the year and the end of the year. And you can see that gives you a different view of the operating results of the business than either the income statement or balance sheet. I kind of call that where gone. Where did the money come from? Where did I get it? And where did it go? It's also another good way to look at the question. Well, if I had a $5,000 profit, why didn't my cash go up from $18,000 to $23,000 if I had a $5,000 profit that I earned and retained in the business? And the answer to that question is the cash flow, because there are a lot of impacts on that bank account other than what's simply shown in the income statement. So different view, and a view that's very helpful from a management point of view. Next slide, Kathy. Here's an example of what I was just talking about. Same P&L in this business, different balance sheet results. Starting cash $22,000. We got the income of $5,000 and add back depreciation expense, but in this particular case, accounts receivable went up $2,000, but inventory went up $3,000. And the increase in accounts payable to trade creditors was only $1,000, so the net cash flows $2,000, not $6,000. And then finally, there's the purchase of equipment, and also the repayment of the loan for $1,000. So the net cash flow in this example is a negative $2,000 instead of a positive $2,000. So cash goes down from 22 to 20. Just a different example of the answer to the question. I started with $22,000. I got a profit of $5,000. Why is my cash not $27,000? Well, the cash flow statement answers that question. All the other things that are going on in the business in terms of balance sheet transactions totally impact the cash account just as much as the income and expense statement does. Next slide, Kathy. Now, here's the meat of really what I want to get further into in this particular webinar. Those two views I've just given to you are historical views of cash flow. The first one was what I told you, the banker's view. That's the earnings before interest, taxes, depreciation, and amortization. They call it EBITDA, and it's basically answering the question, what's the cash produced by the business and is it sufficient to cover the debt service? The second one is the one I've just shown you about the flows into and out of the business, sources and uses of funds, and how that cash flow historical view is different from the balance sheet and P&L view of the business. This third one is the future view, and it's the most important for business management purposes. And planning and managing that cash flow, you managing it, not you being a victim of it, but instead being proactive in managing it, is clearly one of the most important tasks for you as an owner of the business. It's your job to make sure you don't run out of money to meet your payroll. In current circumstances, restructuring and restarting your existing business under the umbrella of COVID-19 it is almost like starting up a business all over again for the first time. It's going to entail a struggle with cash flow. In many cases, business owners are facing ramping up to almost full operating expenses in restarting or reopening their business, but low initial sales until they get going fully strongly, which can certainly equal negative cash flow for the first 6 to 12 months of a business. And that's very, very normal for business startups. A lot of businesses take 6 to 12 months or even 18 months before they're generating a positive cash flow. Imagine if you're a bar restaurant business and you've been shut down tighter than a drum. You've only been doing takeout, and now you've been allowed to open up your business as long as you're serving customers, outside, and then tomorrow you're going to be allowed to serve customers up to 50% of capacity. But how many bar or restaurant businesses can operate successfully at 50% of capacity? I don't know very many. And so for them, it's going to take a while, until that negative cash flow becomes positive. So planning for that requirement in those circumstances is a critical management process. In some cases, businesses may need to do a week-by-week projection of cash inflows and outflows, but most certainly you need to do a month-by-month projection in order to do that planning. As I said earlier in this webinar, if you know what you're going to need, you can figure out a way to get it, because there are a lot of ways to skin the cat in terms of sources and uses of funds. Obviously PPP loans in the last 3 months, and obviously EIDL, or Economic Injury and Disaster Loans from the SBA, has been a huge source of funds. Like grants and loans from local operations like Recovery Lancaster has been a big source of funds, and will be a big source of funds for a lot of small businesses. And then, of course, working with your friendly banker to meet your needs, is another way to skin that cat. But you need to know what the requirements are before you can tackle the issue. So cash flow forecasting is critical. Let's take a look at the process. Next slide, Kathy. Yes. I broke that apart into 2 slides, and I basically have said what I wanted to. If you project a shortfall, you've got to be proactive in addressing that problem in terms of figuring out how you're going to manage your business if you're forecasting a shortfall in funds. I put the last bullet point in there for a specific reason. There are a lot of businesses that collect sales tax on their products and services. There are a lot of businesses that have payroll withholding tax on employee pay. And if you're short, it's tempting to not pay your sales tax, not remit it, or not pay payroll taxes on a monthly basis as you're supposed to do. And this particular bullet point is pleading, don't fall into that trap, because not paying tax obligations on time is an easy way to preserve cash, but it's a very painful way in the long term, because government, state and federal, are not very nice about businesses that don't remit their payroll and sales taxes on time. Their attitude is it's not your money. You just collect it with one hand and pass it on to the government with the other hand. And the cost of borrowing money that way, in terms of penalties and interest and interest expense, is prohibitive. You don't want to fall into that trap. Next slide, please, Kathy. Now it's time for me to introduce to you a simple 12-month cash flow Excel spreadsheet. And Kathy is going to pull up a blank example of that particular template, and then I want to show you a filled-in example. We're going to make sure that you get a copy of the blank template and an example of this template, so that you can use it for your own purposes. And the way to look at this is that this is simply like a checkbook. Kathy, scroll so we can see lines 4, 5, 6, 1, 2, 3, 4, 5, 6, etc. Just scroll up and down so you can see the beginning of that worksheet. The way to think about this is that this is just like a checkbook. You're starting out with a certain amount of cash on hand at the beginning of the month, say beginning of January 2020, and you're forecasting all of your cash receipts, that first blue line, and the items underneath it, are the various types of cash receipts that are normal for the business. And then forecasting all the cash disbursements, cash paid out. And there's a whole series of those, underneath the cash disbursements. And then forecasting principal repayments on debt and capital purchases, and maybe owner's draw or owner's distribution, so that you've got a total of all cash paid out. And the difference between the two is the cash at the end of the month. So it's beginning cash plus cash receipts minus cash disbursements equals ending cash. And then you start all over with the same number on February 20th. You do it again for February, do it again for March, do it again for April. And you're forecasting month by month cash receipts and disbursements based on everything you know and based on your very best estimates of most probable results of your business going forward at any beginning, at any point in time that you want to start the process, to answer the question, how much money am I going to need, and I'm going to be okay, or I'm going to have a shortfall, and if so, how much, and when it's going to impact. In my personal case, I do personal cash flow forecasting. I don't know, maybe it's just because I'm anal retentive, which is true. Numbers guys usually are. But I know that I've got $12,000 of real estate tax and home insurance to pay in the month of August, and I don't happen to have $12,000 of surplus funds sitting in my bank account, so I'm going to have to tap my working capital home equity line of credit to pay those bills in August, and then pay them back. I'll pay the line of credit back as I have surplus cash flow and months going out. Well, I mean, I have a home equity line of credit for exactly that type of purpose, because I know what I'm going to need, because I've forecasted in the future, and I've created a plan, for it. And managing your business the same way is just the same process. The template that you will see when you get it has that little notes on preparation down at the bottom right hand corner that Kathy is showing you, and also the instructions for use of this particular template are in the second tab. And so reviewing those notes and reviewing those instructions before you tackle actually entering your own numbers into the cash flow forecast is going to be very helpful to you. And highlighted in red in the notes on preparation say that if you click the corner of that text box, click and hold and then press the delete key, it's going to disappear. It'll take it off of the blank template so that you can use the template without having the notes obscuring your view. So once again, a simple 12-month cash flow forecast, one-page Excel spreadsheet template to help answer the question, what do my expected future cash flows in and out of the business look like, and is it going to be sufficient for my needs? I've got some clients that only do a 6-month cash flow using this template, and they update it every month. They just keep it rolling forward 6 months at a time. If I'm doing it, I'm going to do a 12 months cash flow to begin with, because I want to see at least a 12-month view of my expected future cash flows. And then maybe I do a second one that's just a 6-month view and keep that one rolling and updating it month by month by month with new developments and new understanding and new expectations, because things are going to change, based on reality as it occurs, and updating the forecast on a monthly basis makes sense. Kathy, let's look at the next spreadsheet, which shows some example numbers. Bear with us, folks. We haven't lost us. We got a sample coming up. There you go. And once again, Kathy, can you scroll so we can get back up to the top so we can see lines 4, 5, 6, etc. In this example, you're going to be entering the name of your business. That's in Kathy's pointing to it now. That's in cell G2. You can also determine when you want this thing to start up. So your startup date for your business, might be July 1st. So you can change the top labels, that show the dates of each, or the months of each one of the columns, so that you can be starting it up at any point in time. But you're entering, in this particular example, I'm showing $45,000 of cash as of January 1st, 2020. Business is expecting to collect accounts receivable of $20,000. So total cash available is 65, 45 plus 20. And then the business expectation is to be paying out cost of goods sold, material and labor, $26,800 for convenience purposes. I showed wages and payroll taxes is another line, and then simply showed all operating expenses, $4,375 as an outflow, instead of showing all the details. For this example, I didn't want to get involved in showing tiny little numbers of advertising, accounting, rent, telephone, utilities, and your business should want to spell out all of that. But that's a $45,689 of cash outflows, plus principal and interest repayment of $833, meaning that the cash I paid out is in excess of the cash that came in. So my ending cash at the end of the month has dropped down to $18,478. And that number, scroll back up at the top for me, Kathy. $18,478 is the beginning cash in February. And I'm expecting to collect $40,000. I'm expecting to pay out cost of goods sold and wages and expenses. And at the end of the month, my cash flow out is exceeding cash receipts coming in, and my bank account has dropped down to $11,956. As I'm going out month by month by month, March, April, May, June, July, look at the balance at the end of July. And it's a negative $43,305. Well, you can't have a negative balance in your cash account, can you? And so obviously, you're looking at future expectations of where cumulative cash flows going out are exceeding cash flows coming in. And it demands a need for additional bank financing or financing from owners, as the case may be. So let's look at how you solve that problem by going to the next template, Kathy. And I can take a sip of my coffee while Kathy's working to change the template. Well, in this particular example, what you do is you eyeball the bottom line expectations of cash in the business, and you say to yourself, I don't want to have cash less than $5,000 at any given point in time. So beginning in March, I'm going to have the need to increase my bank line of credit, BLOC, bank line of credit borrowings, by $10,000 to make sure I maintain a roughly $5,000 cash balance. I'm going to have to borrow another $27,000 in April, another $7,000 in May, $1,000 in June, $5,000 in July. But then I'm going to begin to pay it back. I'm going to begin to pay back some of the bank line of credit because I've got surplus cash flows. In the next few months, I'm going to eyeball that I only need $5,000 of cash in the bank. So I've got enough money to pay back $3,000 on my line of credit in August. I've got enough to pay back $4,000 in September, enough to pay back $1,000 in October, $5,000 in November, etc. So you can eyeball that and say to yourself very quickly, 10 plus 27 is 37, another 7 is 44, 45, roughly $50,000. I need an additional $50,000 of bank financing between March and June in order to finance my business until such time as my cash flow starts to become positive, and then I begin to pay it back. Now you've defined, number one, the need for funds, and number two, the size. You know, what's the amount that you actually have to have in order to finance the business plan. I've got to have a source of funds of an additional $50,000, and it could be owner's investment, it could be friends and family, you know, it could be an SBA loan of some type, or it could be a drawing on a bank line of credit. Kathy, slide go down towards the bottom of this particular template to the second yellow line. You know, I stuck that one in because you know, if you're borrowing money from your friendly banker, you also have to estimate what's the interest expense going to be on that bank line of credit. So, you know, I just took a simple example of assuming, I think I assumed 6%, I don't recall, and said, you know, what's 6% interest on the bank line of credit borrowings, and stick that in as a cash outflow item because I've got to pay the interest expense on a monthly basis. That wasn't in the previous template, but it's a new item in here. Look down at line 37. In the month of March, I've estimated that I've got to make a fixed asset purchase of some type of $10,000. So it's a use of funds. I'm going to buy a used F-150 pickup truck for my contracting business, you know, that I'm able to pick up for $10,000. Not much of a truck, is it? You know, but it's going to cost me $10,000 to buy it. I'm planning to buy it in March, and I'm going to need a source of funds to cover that debt. That's where one of the bank borrowing requirements came in. Look at line 40. $20,000 distribution to owners in the month of April. Another $5,000 planned distribution of profits to owners in July. Another $5,000 in October. Why $20,000 in April? I got to pay income tax. You know, well, this year it's July. You know, but normally I've got to pay income tax. So I take a draw out of the business to provide the funds that I need, you know, to pay personal income tax on my business if I'm a subchapter S corporation or a limited liability company, and I'm paying taxes personally. Then I'm distributing the money out of the business to provide the funds to pay my tax. I've got to account for that in my business planning. So this particular template provides all the normal types of cash income and expenses that you're going to run into in your business. You can change the labels on the left-hand side, column A, to suit you. You see in line 31, 32, 33, 34, those have got labels of other. You know, you can change those to your own terminology or nomenclature so that you are understanding what you're talking about. And so any of the labels can be changed in ways that are meaningful for you. The first time you ever try to do this, you know, it's like the first time you ever tried to get onto a tennis court and hit a tennis ball. You know what you're doing, you know. But if you practice a little bit and do it a few times, it starts to become comfortable to you, just like trying to hit a a ball across a tennis court net. And after a while, this is my experience and my experience of working with clients, this becomes like second nature, you know, and it's pretty easy once you become familiar with the process to update your expectations regarding future cash flows, so that your planning gets closer to reality, just as reality gets closer to your plans as you go out. So that's a simple 12-month cash flow template that can really become your friend and a very important tool for you in managing your business in the future. Kathy, next slide. I think maybe it's the last slide. We've done that one. Yeah. Yeah, we're about ready to wrap up. That's good. We're close to on time. A little pitch for SCORE. You know, if you don't already have a SCORE mentor, would strongly recommend that you go to our website, which is lancaster.score.org, you know, and register online for a SCORE mentor. We have over 80 volunteers in the Lancaster SCORE chapter. It's an outstanding SCORE chapter among 300 chapters in the United States. SCORE has been in business as a small business counseling organization for over 50 years. It's nationwide. And in Lancaster, we have an outstanding group of people that have got in-depth knowledge and experience in marketing and operations and human resources and financial management, you name it. So working with a SCORE mentor to have a sounding board, a devil's advocate, somebody that you can just talk to about your business situation can be an invaluable resource for you. Sitting down with a SCORE mentor on a monthly basis to review your financial statements and do a SWOT analysis, strengths, weaknesses, opportunities for improvement. Asking your SCORE mentor to assist you in developing and using the cash flow forecast or projections template is all things that we do on a regular basis with our clients, and we're more than happy to assist you with that process. And as I suggested before, recognizing that these are critical times with regard to cash flow management and perhaps arguably unprecedented, is important for your business process. Finally, using your accountant to assist you in business financial management at this point in time more than ever before, rather than just asking your accountant to prepare tax returns. You know, meet with them on a quarterly basis, you know, to review business financial management issues and planning needs. They can be an enormous resource for help and assistance to you. Was there a last slide, Kathy? Yeah. Pretty obvious. Financial statements do contain a wealth of information about a business. I have said to my clients over the years, you don't need to be an accountant. You don't need to be a bookkeeper in order to be a successful business manager, a successful business owner. But the language of business is money and numbers. And you have to learn the language of business in order to be successful in managing your business. You can hire people or contract out with people to do accounting and bookkeeping for you. But learning to use your financial statements to manage your business and learning to use a cash flow view and cash flow projections for managing your business is your responsibility. And you can't delegate it to anybody else. You have to be responsible for it. And if you become responsible for it and make yourself knowledgeable about the language of business as contained in the financial statements of your business, you're going to be a lot stronger, a lot more successful, a lot more profitable business manager. So this is an excellent planning tool and an excellent business analysis tool. And I hope you'll find it worthwhile in using in your business to help you become a better manager. Thanks for being with us. I'm happy to open this up for any questions that you guys want to talk about.
It looks like they did one question so far. I actually don't have answers.
Is that Paige? You're breaking up, Paige, badly if it's you.
It is me. So I apologize, I don't have a connection where I live. I have a question here that says, can you still hear me?
Paige, if that was you talking, it was broken up really badly. We couldn't hear you at all.
Okay, 1 second.
Paige, let me ask one of the questions that came up on the web chat. So one of the questions was, how can we access the spreadsheet used in the demonstration?
Kathy, that's for you and Paige to answer, you know.
So Lou has provided the presentation and the 3 spreadsheets that we went through today, and we'll send those to you following today's meeting so you have those as a tool you can use within your business. Are there any other questions? You're all good cash managers. Here's another one that came in. Just wanted to say that they really appreciated today's presentation, needed to hear it. And I think that's something that Lou emphasized as we work with small businesses. These are not things that are natural for people to be skilled in and know what to do, and that's okay. But I think Lou's last slide was really important. You need to understand the language so that when you have your financial sheets prepared, you can understand what they're telling you so that you can make the right decisions to spend, not spend, where to spend, so that you can grow the business profitably and do it in a healthy way where you have cash flow to be able to support your growth and operating plans.
Yeah, and I'll add to that, folks. This financial management stuff, quote unquote, is not rocket science. It's stuff that you can learn. I'll never forget a young woman who was in a face-to-face live workshop a few years ago. It was a business financial management workshop. And she came up to me at the end of it and she looked me in the eye and she said, I want you as my business score financial mentor. She said, I know everything about my business from an operations point of view, from a sales and marketing point of view, from a people management point of view, from any point of view that you can name, but I stink in terms of business financial management. I don't understand it. You know, I shy away from it. You know, you can beat me with an ugly stick, you know, just don't make me do financial management stuff. She says, I need you to help me with this. And I began to work with her. And like anything else, it's just simply a matter of time and effort and practice. She got so good at business financial management. She's a franchise business owner. She now teaches this stuff to other franchisees across the United States. You know, her name happens to be Kathy, not Kathy Bonzer, but Kathy somebody else, you know. And if she can do it, you can do it too.
Thank you both so much. Are you able to hear me now?
Yes.
Yeah,
yes.
We can, Paige.
Perfect. It looks like we just got another question here too. Do most businesses need to have an LOC in order to operate? Is the goal to eventually be self-sufficient? or is that not commonly done? And is it best to have a backup of cash / via a loan?
A great question, Amanda. Let me try to answer it this way. Think back to that balance sheet example, $100,000 of assets. What are the sources of funds to support those assets? One is owner's equity. Another is bank debt, and a third is traditionally accounts payable to trade creditors. I believe in using bank financing as a source of funds to manage your business. I don't believe that the business needs to be financed totally, solely, only with owner's equity. I think borrowing money, is a normal thing to do with any business. In fact, if I could borrow money from my friendly bank at 5% per annum, today a bank line of credit is more like 4% per annum. If I can borrow money at 4% per annum from my friendly bank, and I can use that money to make a 15% return on my owner's investment, then I'm going to be happy to borrow money at 5% all day long. I just don't want to borrow so much money that I get myself in trouble with interest expense that overwhelms the profitability of my business. So I'm trying to work up to the answer to your question, which is that it's perfectly normal for the vast majority of businesses to have a bank line of credit available to them for funding their business. And it is not necessarily a normal goal to have zero debt. It's a much better goal to have a profit that provides a return on stockholders' equity in your business higher than you can get by putting your money in the stock market. That's the way I look at it. And using bank debt to help you achieve a return on equity is a very normal process. It doesn't mean that you necessarily want to be tapping that bank line of credit for thousands and thousands and thousands of dollars constantly, but having it available to use when you need it and being able to pay it off when you can be a very normal thing for any type of business.
Perfect. It doesn't look like we have any more questions. She said, thanks, that makes sense, especially about the interest.
Yeah.
So thank you both so much. Kathy and Louis, do you have any other final closing comments or anything that you'd like to make, or would you like me to just wrap that up then?
I think the only thing is to reemphasize to our participants that if you do not already have an active SCORE mentor, y'all come, you hear?
Yes, I would agree with that. Everyone at SCORE is incredibly helpful, and I've had the pleasure of getting to know a lot of the team at SCORE, and they're just all incredibly knowledgeable and just so willing to share their expertise. So today was a great example of that. Thank you both, Kathy and Louis, for sharing that information with us.
Thanks for the opportunity, Paige.
Yeah.